All right, what are the potential returns of investing in multifamily? To answer that question, let's talk about the different kind of returns there are and basic concepts. So there's a cash on cash return, the average annual return, and the internal rate of return. So we talk about all three of those, and then we'll kind of talk about, hey, what returns can we expect if we invest in a multifamily syndication? Ready? All right, let's go. Let's get right into the cash on cash return. And cash on cash return is the amount of cash flow that is distributed divided by the amount of money invested. Okay, so for example, if you're investing $100,000 and you receive $10,000 of cash flow distributed to you every single year, your cash on cash return is $10,000 that you get divided by the $100,000 you invest. So that's a 10% cash on cash return. Okay, so that's pretty straightforward. The average annual return is essentially how much money on average are you getting. So you have to look at the entire deal itself over the lifetime. So it's the total amount of money distributed in profits you made divided by the total number invested divided by the number of years. So here's an example. So let's say you're getting $75,000 that you are making in profit and distributions. So you're getting cash flow distributions at the end. When the property sells, you get a nice profit check at the end. You add it all together in $75,000. You invested $100,000, and the whole period was 5 years. So you take $75,000 divided by the $100,000 you invested, and then you divide it by the number of years. So it's a 15% average annual return, which is pretty neat, right? So every single year, you're getting a 15% return on your money through a combination of the cash on cash return and then the profit at the end. And of course, the loan is being paid down by the tenants as well. So that's the average annual return. Those are two very, very important metrics when you're looking at deals. Now, if you want to get advanced, here's the internal rate of return. And I don't want to spend a lot of time on this thing, but if you heard the internal rate of return, or the IRR, it's basically a measure of return, and it's the most mathematically correct out of any method to compare one investment vehicle with another, whether it's stocks, precious metals, single family housing, whether it involves cash going in, cash going out, it doesn't matter. And so basically the way it works is Excel has a fantastic function, and it's called IRR. All right, and it basically takes the money that's in this case, let's say it's a $2.9 million investment. And then there's cash flow distributions, then there's some money back from refinance, and then there's a profit at the end. So those are kind of the things that you're seeing going on in this table here. And the IRR takes all that into consideration and then uses the net present value of time to calculate the internal rate of return, because money is worth more now to you than it is down the road due to a variety of factors. You know, there's the inflation rate, but there's also, hey, it's better to have a bird in the stone than two in the bush, right, kind of thing. So the internal rate of return is the most precise way of measuring one investment to another. But it's very advanced, as you can see here. So I don't want you to get too caught up about the internal rate of return. I would just advise that you stick with cash on cash return and the average annual return. Those are the most easy to understand. All right, let's do an example here. So this is for a chart that shows you the overall return of a multifamily investment. Okay, so the top line is and this is an example where the investors are putting in $2.9 million, upper left-hand corner, and you see there's a refinance at the end of year 2, and then there's less money in the deal, and then there's a sale in year 5. So this is kind of a typical value add deal, but from a return perspective, it's a complicated thing to look at. So let's look at each of these things here. So the investors are putting in $2.9 million. And then in the first year, there's very little cash flow because it's a value opportunity. And the cash flow jumps up to $245,000. There's also a refinance there. So if you can look at the column on cash return, you'll see that the cash on cash jumps dramatically after the refinance. Now, why is that? The reason for that is because the refinance returned 75% of the investor's capital. And so the actual cash on cash return is higher because you have less money in deal, which is really, really cool. So if you look at the average cash on cash return, it's actually 21%, due largely to the refinance. So this is a fantastic deal. The first year, the cash flow is a little skinny. Second year, it's pretty solid. And then after the refinance, it's just amazing. So you get back 75% of the deal. The risk is off the table, and the investors continue enjoying cash flow. That's just the best of both worlds. So if you look at down the return of member capital there, you see about $2 million is being returned to the investors, reducing the member capital account balance. So that's pretty cool here. So the cash on cash is pretty great. Now, because this is a refinance, the internal rate of return, or IRR, is almost 20% on this deal, which is outstanding. So this is an example here of how returns are measured. And just keep in mind that when there is a refinance, the average annual return is not meaningful anymore because your equity is being reduced. In a case of a refinance, you have to use the internal rate of return to be able to compare one investment to another. Okay, now what kind of returns should you expect in a deal? You get a deal, what's kind of ballpark? And let me just say here that this changes from month to month and year to year. The market is ever changing, okay? So sometimes returns are trending higher, sometimes returns are lower. That really, really depends. Now, where we are right now, we're going to give you some ranges, and I'm going to tell you why it varies a little bit. So let's see what to expect. Let's look at the cash on cash return. The cash on cash return is typically between 8 and 9, sometimes 10% upon stabilization. Stabilization means that the property is now performing as it's supposed to. So in the previous example, the cash on cash was a bit minimal because it was maybe vacant, the rents were under market, expenses were high, and the sponsor team is working to make it perform the way it should. Upon stabilization, typically is where occupancy is 90% or higher and the rents are at market. And that's really what stabilization means. So what we're looking for is 8 to 10% cash on cash return over the life of the investment. And we would like the target 9% to be at year 2. In other words, we don't want to wait 3 years until to reach our target. We want that to happen in year 2. So that's a cash on cash return. Next is the average annual return. So we're really looking for average annual returns between 14 and 18%. Now, why the variability? Well, it depends. It depends, for example, on what market are you in. Are you in a primary, quote, headline market like Atlanta or Dallas? Well, those are great growth markets. And to get in that kind of growth market, the returns are going to be slightly lower. Also, the assets, if the asset is nicer, so the class B or B plus asset, they're newer, less things can go wrong, the tenant base is of higher quality. So for those kind of assets, you may have to, because they're harder to find, the returns are going to be lower in return for a nicer asset, less problems, and less risk. Versus if you go to maybe secondary or tertiary markets, or you go with Class C assets, then the returns could be a little bit higher. Having said that, though, the difference in returns between Class B and Class C these days are somewhat minimal. They're right around this range that I'm describing you right now. But if you find a deal with a strong operator in this ballpark, you're doing very well. The internal rate of return, we're looking at 13 to 17%. And because the way the math works in the internal rate of return, the same deal, if there's no cash out refinance, mathematically, it's going to be just a little bit below the average annual return because of the net present value of time. Don't worry about it too much. The point is, if you're looking at internal rate of return and you're only doing this if there's a refinance or you're more sophisticated, we're typically seeing deals between 13 and 17%. Again, primary headline markets are lower return. Nicer assets, Class B or B plus, lower return. Also, if there's a heavier value add component, okay, there's more work to be done, the risk goes up, then that should be a higher return, closer to the 16 or 17%. So that's the summary of the different kind of returns. We talked about the cash on cash, the average annual return, the internal rate of return, and some rules of thumbs of what to expect. Hope that helps you guys make better investment decisions.